Well, hello, everybody. Welcome back to the Insurance Lounge with me, Tanya.
And I'm Kristy.
We are your local insurance agent out of Chattanooga, Tennessee. And we are here to make insurance a little less boring and way more useful for you. Our goal is to share with you what we know so that you will feel more confident about your insurance and how to better protect your family, your home, your business, and most certainly your financial future. So, with that said, Christy, would you please do the honor and kick off our topic for this week?
You bet, Tanya. And I like this one, right? This is a juicy one because this is kind of trending on social media lately with people talking about how insurance is a scam and they're just going to self-insure. So today, let's break it down for folks. What would that really look like? And why might it work for you, but why might it not work for you?
Absolutely, Christy. So let's dive right into it. So, I'm all about, being financially independent, right? Like who would not
Absolutely.
be? Come on, that's just the truth. So let's break that down, right? Like we know that a lot of time, and I think is a fair point, right? If you're insuring your home for a long time and you're a great homeowner and you keep paying for your insurance premium, you never get to use it in a claim. So over
Mm-hmm.
time, it might feel like it's worthless, right? The value of
Right.
what it's bringing to you is not worth having your home insured. So today we're going to focus more on that, especially for those who pay off their home, right, Christy?
Yeah.
We can't really do that if we have a loan with a bank. We really can't do that right now with the DMV requiring having insurance when you register your car or to be able to drive
Yeah.
on the road. So we're just going to solely focus on those folks who might be in that position to consider, like, do I want to self-insure? What does that look like? So let's dive into it. An average home premium, what would you say, Christy? To be fair.
And in this area, right? So around 17, $1,800 a year-ish,
Yeah, yeah.
average on average.
I
Certainly higher and lower examples exist, right?
absolutely. I think that's a fair premium amount. So now what if I have a home that I love and I paid it off because I was very responsible, right? So now I'm at this crossroad. A lot of people talk about investing it into the market and get a better return on that.
hmm
So can you kind of break it down a little bit for our audience of what that looks like over time?
Well, yeah, I mean, sure, if you are taking 17, $1,800 a year and just investing that, right, rather than paying an insurance premium. There are lots of different avenues and vehicles that you can use to invest that money, some with higher returns and some with lower. So it's really going to be a lot about, what's your appetite for risk and compared to what's the risk of something catastrophic happening to your home in those early years as you're trying to build a fund that would help you self-insure against damage to your home, right?
Sure.
So at just that, $1,700 a year, if, and around here, tornadoes, right? We're right in the middle of Tornado Alley, right? You can easily have, a catastrophic loss to your home. If you got a $300,000 loss, how long is it going to take you to have built up that kind of savings fund to be able to make the repairs to your home, and where are you going to be while the home is getting repaired, and how are you going to pay for that as well? There's so many things to consider that I think the by and large the average Joe who's kind of complaining out there on social media these days doesn't really think about what all of the impacts could be to not having a traditional homeowners policy.
Sure. Yeah. And, to see it from their point of view, right? So it sounds very sexy and very
Very
attractive,
appealing. I'd love to not
right?
pay that $1,800 a year. Yeah.
Absolutely. And you know what? Like, who doesn't want a potential higher return, right?
hmm
With the money that you put in. And then, of course, at the end of the day, Christy, if that's my money, instead of spending that $1,800 or that $1,700 to, give it to the insurance company. That's my funds. I get to keep it. And so it gives me that control and that flexibility, right?
Right.
And then plus, I don't have to pay for things that I don't need,
Not
right?
using, right.
So,
Yep.
so let's dig into that. So we know that there are potential financial ruins, like you mentioned, right? If you get hit by a tornado, that cost could be very catastrophic. It could be very large. And plus, there are a bunch of other missing coverages that we don't have. But
Right.
let's run with that average Joe that is a little bit angry at the insurance company right now, right? So let's say if I was very savvy, Christy, and I am going to look into different avenue of putting my money to
Hmm.
invest. I would say the first thing is I will probably look at the money market account, right? Like maybe go to
Safe.
your
It's
local
good and
bank.
stable, right? Yeah.
Yep, yep. And let's just say, if my money market account and I got really lucky and I have a 5% return, Christy. So,
And you'd be really
um,
lucky to have that right now. To be
so
totally honest, that would be really lucky.
absolutely. But let's just say, like if I were to put $1,700 in every for 10 years at a 5% return, Christy, what does my saving look like at the end of 10 years?
Yeah, so you've saved some $17,000, right? $18,000. Your growth is around 4,500. So, modest growth, lower risk. You got about $22,000 now after 10 years.
Okay, all right.
If you didn't have any damage during that time, you're looking good.
Awesome, right?
Yep.
Okay, and now so let's talk about like what about those of us that can get something more like maybe a 7% return or a 10% return. What does that look like at the end of 10 years?
Yeah, sure. So again, you saved at the 7%, you've still saved you've saved around 17, 18,000, you've gained about 6,700. Even at 10%, you've gained another 17,000, right? 10,000. I'm not good at math. So there are definitely, there's a little better growth there. But you're still in a situation where a big loss could really hurt you. A $300,000 loss on your home because you had, a water leak upstairs and it leaked, downstairs and ruined the flooring and the walls and everything, or the tornado that we talked about, there's still a big risk there.
Okay, so after 10 years, I better hope that I don't have any damages to my home, right, Christy? Because
Yep.
maybe 20, 25,000 after 10 years of investment is
Still
still not enough.
not enough to take care of a big loss. Yeah, exactly.
Sure.
Yeah.
Now, what if
And
I'm sorry, go
yeah,
ahead.
I would think we're going the same place, right? So what if you're that really aggressive investor and you're comfortable in investing in something like crypto, Bitcoin, those types of things that have almost a 50% annual return, possible. um, There, you do have like a $300,000 growth over about 10 years, assuming you've not had any crashes, you've not had any big loss. One bad year in that market could really hurt you. There's a lot of volatility in that market. So, for one thing, not everybody is comfortable investing that way. And for another thing, even if you are, if you have one bad year, you're taking a big loss.
Absolutely, right? So like even if we're looking at something very safe that most of us might have, which is investing in an index fund with an
Hmm.
S&P 500 or something like that, it's been doing good, right? Since 2008, we haven't had any issues. But if we
Right.
were to have a 2008 where the market dropped by 38 points, it could really hurt us, right? Especially if we don't have a lot of disposable income
Yeah.
or large savings that we set aside just to cover damages on our home.
Right.
Um,
But I think you just hit on something, Tanya, that's really, I mean, I'm just going to come right out and say it, that's critical. If you don't have a lot of disposable income, this is not the solution for you. It's just
It's quite
not.
scary, I would say.
Yeah.
Yeah, quite scary. So now let's touch on that because now we can, we get an idea of, how much we need to put away and how much we're getting back.
Mhm.
So as a homeowner though, even if I paid off my home, Christy, what are some reason why, besides, that catastrophic damage, right? Like we
Yeah,
know
yeah,
if the tornado tore down the home, more than likely we will need at least 250, 300,000 plus, right, to
exactly.
deal with that
Right, right.
damage.
Yeah,
But what are some other things that are that comes with a homeowner's policy that,
yeah.
maybe an average Jane like you and I would want to have a homeowner's policy?
Yeah. Well, we talked a little bit about, the coverage in your policy that's called additional living expenses or loss of use, some companies will call it. So that's money that's there in the policy to pay for you to stay and live, somewhere else while you can't be in your home if that's happening. So that's one thing. But the biggest thing to me is the liability coverage that's not really going to be covered in your self-insurance plan. So someone slips and falls in your driveway, falls off of a wall somewhere or a deck, and if you're found liable for that, you could be talking about a big, big loss for their
Yeah,
medical
especially.
expenses.
Exactly. And especially if you have a nicer home with a large swimming pool, for example,
Oh
right?
gosh, yeah.
Or maybe you have younger children and you want to give them a big old trampolines, for
Mhm.
their friends can
Mhm.
come over. Those are probably high risk. I think for those of us out here, if you are into golfing, you are into hunting, there is a chance when we're out and about that we can accidentally hurt someone, right, Christy?
Sure, sure. Yeah. I think about like in my situation, we have a little bit of land, which is great, and the kids ride four-wheelers. And it scares me to death. As an insurance agent, it scares me to death. I'll just be honest. But,
Absolutely.
those are things that people do, and you just don't think about, what someone getting hurt doing something like that at your house could do to you from a financial perspective.
Absolutely. The other liability risk that I think a lot of homeowners don't really think about, but we all do it, is a lot of time we hire help, right, to
Oh,
get
yeah.
helped around the house. It could
Oh,
be a
yeah.
roofer on the roof. It could be your handyman, right, fixing the siding or something like that. At any time, unfortunately, right, Christy, if your name is on the deed of the house,
Yep.
you are financially
You're on the
responsible.
hook. You are.
Yep,
Yep.
every time. And that could be very devastating, right, Christy? Because
Absolutely.
when people are suing you for things like that, it's not just their medical bills, but if they decide to hire an attorney,
And
l-
yeah, their
a-
loss of income, their, loss of potential. Yeah, it can be devastating.
absolutely, absolutely. So, in conclusion, Christy, are a who's actually a good fit for
Yeah.
self-insuring?
Yeah, right. So it's not me, right? I wish it was, but it's not me. My home is paid off, but I don't have a lot of liquid assets. I still have a kid in school who, I'm paying tuition for. So it's somebody really, though, who is relatively wealthy, has the liquidity to be able to deal with a catastrophic loss. It's also somebody who's disciplined enough to actually take that money and save it and invest it every year and move it around and make sure that you're maximizing your investment. I think it's somebody with a relatively low risk demographic, with regard to their lifestyle as well as where they live and what kind of losses, are potential for your home. Um, and somebody who's risk tolerant if you're going to, try to hit those higher levels of investment and return.
Absolutely. So I guess a good rule of thumb for those who are wealthy, right, Christy, is maybe at least a million plus in cash asset,
Yeah, I think
right?
so.
Something that, let's say, if something were to happen, you are ready to part with $300,000 off of your saving. and you're okay with that.
Yep.
I
Yep.
think a lot of us want to keep that 300,000. Maybe we don't have children that are going to college, but if we are lucky enough to stay alive, we got to worry about our retirements, right?
Right. Yeah.
And I love that you mentioned, the low risk lifestyle. So not just that you don't have a pool or you don't go out hunting, right? But it's also you don't live in a hurricane area like
Mhm.
in Florida by the coast, for
Sure.
example.
Sure.
You might not want to chance that because it happens way too often, right?
Yeah. I mean, like the past 10 years, even just around here in Tennessee, the storms, thunderstorms and wind and hail damage have been just outrageous. So it's
Yeah, and
not just hurricane areas that are, highly
mhm.
risky for losses.
Yeah. Or if you're out in the West Coast, and your home is more into
Fires.
the brush area,
Mhm.
wildfire can happen at any time. You might not want to chance that.
Right.
Um, right. So, in conclusion, let's give our listener a quick recap, really quick. What are some good reason why, um, if someone that can afford it and can tolerate it, what are some reason why they want to consider self-insuring?
Sure. Well, I mean, obviously, there's appeal to being in control of your money, being able to invest it where you want and use it like you need.
Hmm.
Um, there is the avoidance of overpaying for coverage that you're not using, and there's the potential for higher returns and cost savings. So I think those are
Absolutely.
really appealing pros of the approach.
Absolutely, very attractive, right? So now, if something that's giving you good returns, we know it's also come with a lot of risk, right? So, some reason why you might not, want to self-insure or going down that route is not a good fit for you is, you got to consider the risk of catastrophic losses, right? At a minimum, if someone were to sue you or if a disaster strike your home, easily 250,000, 300,000 could go out the door.
At a
And
minimum. Yeah.
at a minimum, and you and I both know it takes a long time for us to build up that kind of asset, right?
Yep.
Also, if we don't have a homeowner policy, we do have to be responsible for other things that we might have exposure to that typically is covered under a homeowner policy, like liability, right? That
Uh,
doesn't come when you're self-insured, but it comes on every single homeowner's policy. Or if you're like me and you're not a gambler, um, you know, I cannot stomach the risky type of investment.
for
That
sure.
might be the downside of, being self-insured.
Yep. Absolutely.
So if you don't have $1 million plus in cash and that you're ready to just part with $300,000. Um, if something were to happen to you or your home, right? You have the extra cash to live where you need to live in case your home is damaged and is not livable. Um, then um, then insurance is
By all
probably
means.
for you.
Yeah. Yeah, and
Awesome.
just the peace of mind that it's going to give you, along with the financial protection. It's just something that you have to figure I'm paying for the possibility that I'm going to need it. That's what it is.
Absolutely. And if you don't have an agent that you can reach out to and make sure that your policy is up to date, and reach out to your agent, right, Christy? Do a quick
Absolutely.
policy review. If you think you're paying too much, I'm sure your agent will be able to find you ways to help you save some money on your insurance.
Absolutely.
All right, guys. Well, until next time, see ya.
Bye-bye.